Moving forward then into Chapter 2, we're going to be, among other things, expanding on the tax formula. But before we do that, let's revisit some of the tax returns that we talked about in Chapter 1. You'll recall that we discussed three primary tax forms for on the federal side of our tax system, and that is Form 1040A, 1040EC, and Form 1040. Forms 1040A and 1040 are more complex, and 1040 is the most comprehensive or complex. And the authors recommend that the taxpayer always use the proper form, and they make that recommendation so that the taxpayer uses the simplest form. One of the new terms we'll learn about in this chapter is adjusted gross income. That is a term that is unique to federal taxation on the individual tax form. And it's calculated by taking the gross income, and then we'll deduct from that a limited number of deductions, and then we'll make any deductions and credits that are based on AGI afterwards. So there are some deductions that will help us determine adjusted gross income, and there are other deductions and then credits that we will net up from the adjusted gross income we've already calculated. So some deductions, for example, will be determined before AGI. Therefore, they will help us to determine AGI. Other deductions will come after AGI and will be then subject to the AGI number. This is the expanded tax formula, and many of the primary components, of course, remain from the first chapter, but we're adding more detail now to this formula. And we start with, as we said earlier in Chapter 1, gross income, and then we'll deduct permitted deductions from gross income to arrive at adjusted gross income, or AGI. And then we'll deduct the standard deduction, or itemized. We'll talk about the choice taxpayers have to either claim the standard deduction or their tax reporting classification or itemize their deduction, whichever is more beneficial. And then we'll deduct from that the personal and dependency exemptions to determine, finally arrive at taxable income. And then it's from taxable income that we'll consult either the tax tables or the tax schedules to determine our tax liability, deduct any credits, add other taxes, deduct other payments or refundable credits, and we'll wind up with either a tax refund or an amount due. Adjusted gross income, AGI, is an extremely important concept in the tax code, and we'll use it quite a bit. In terms of filing status, there are 5 of them, and one is single, and a single taxpayer is not limited, is not married and does not qualify for head of household or qualifying widower status. A divorce or separated maintenance decree must be legally executed on or before December 31st of the tax year, or a divorced person or a person subject to a maintenance agreement do file as a single person. Then there's the married filing jointly, and you must be legally married as of the last day of the year. What determines marital status depends upon what state one is living in. And to file a married filing joint, or MFJ, as it says, it does not matter if only one has earned income. The classification is married filing separately. The taxpayer must be legally married as of the last day of the tax year. Select this filing status. Name and social security number of the other spouse must be listed on the taxpayer's tax return. Only in special or unusual circumstances is it advantageous for a married couple to file married filing separate status. Another filing status is head of household. Here you must be unmarried as of the end of the year. So, for example, a married taxpayer living apart from the spouse during the last 6 months of the year may qualify as unmarried. Must be a U.S. citizen or resident, and then maintain a household for a qualifying person. We'll talk about that in a few minutes. There is an exception regarding maintaining household, and that is that if a parent is, for example, a qualifying person, they can live in a separate household. For example, if an elderly parent is in a nursing home. Another filing status is a widower or widow with a dependent child. You must be eligible to file a joint return during the year the spouse died. So when the spouse dies during the year, then as of the end of the year, you're still considered married. You must remain unmarried during the year the spouse dies, and the 2 years thereafter. You have to provide more than half the support, as well as a place of residence for a child, for the taxpayer and the child for the entire year. So temporary absences, such as child leaving and going to school, are permitted. So we'll revisit those filing statuses throughout this chapter and the remainder of the course. Personal exemptions are for the taxpayer and the spouse. In 2017, the personal exemption amount was $4,050. If the taxpayer is claimed as a dependent on someone else's return, the taxpayer may not claim a personal exemption from himself or herself on his or her own return. And this exemption does phase out as the taxpayers reach certain tax levels. that we must be a qualifying child or relative and have to meet these three general tests. So a dependent taxpayer test. So the dependent can be claimed by someone else. Then if that is the case, then the taxpayer cannot claim this person as a dependent. That is, only one person can claim another as a dependent. That right can be split among various taxpayers, but it cannot be duplicated among taxpayers. So the person claimed as a dependent cannot file a joint return with his or her spouse unless that return is filed only to claim a refund. There is no tax liability on the return, so this is one special allowance for a person who is claimed by somebody else. The citizen or residence test is met, being a U.S. citizen, of course, resident or national, being a resident of Canada or Mexico, being an adopted child of a taxpayer if the child is a member of the taxpayer's household all year. The qualifying child has these 5 then tests that must be met in order to, again, the idea is we want to determine whether or not this child can be claimed as a dependent and get, for example, the benefits of having this dependent on the tax return. So we'll talk about the relationship test, the age test, residency test, support test, and then special tests for qualifying child of more than one taxpayer. And this is where I mentioned earlier that this qualifying child's exempt dependency can be split among a variety of taxpayers. Generally, only one person can claim that person, the other person as a dependent, this child as a dependent. The child generally should be for the age test, the child should be under 19 or under the age of 24 and a full-time student. Also, if the child is totally and permanently disabled, regardless of age, they would qualify then as a qualifying child. Going back up to the relationship test for a minute, what is a child? What is a person who qualifies as a child? Could be a grandchild or a great-grandchild, stepchild, eligible foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister. So what's interesting is that as we look at some of the tests throughout the tax code, how they define certain of these elements or these tests varies depending upon the context. But within the context of claiming dependency exemptions, then these are the rules qualifying a child as a dependency. Regarding the residency test, the child must live with the taxpayer for more than half the year, except for the temporary absences like I mentioned earlier. Support test, child must not provide more than half of his or her own support. The child, notice that this is different from the requirement under a qualifying relative, which we'll talk about shortly. So if they pass these tests, then the person can be claimed as a qualifying child. Then there's the qualifying relative. Here only 4 tests specific tests must be met. First of all, you can't be a qualifying child and a qualifying relative. So the dependent would have to be one or the other. So if a person passes as a qualifying child, there would be no need to test for a qualifying relative. But if they don't meet the tests for all those tests for a qualifying child we talked about earlier, then we can test for a qualifying relative to see if we can claim them as a dependency exemption. So who is a qualifying relative? To be considered a qualifying relative, I mentioned earlier you can't be a qualifying child, but also there's a test regarding the relationship or member of the household. So a qualifying relative must be a member of the taxpayer's household for the entire year or be related to the taxpayer. Only certain persons are considered related to the taxpayer then. And I mentioned many of those before, but that list is expanded now for a qualifying relative to include father or mother-in-law, brother or sister, parents, son-in-law, daughter-in-law, father-in-law, so all the in-laws basically. There's also a gross income test for the qualifying relative test. And this gross income test says that a qualifying relative cannot have gross income equal to or greater than the exemption amount, which is $4,050 in 2017. And then finally, with the support test, the taxpayer must provide over 50% of the qualifying relative's support. If they pass those tests, then this person may be a qualifying relative. In the event then that the taxpayer does not itemize deductions, they can claim a standard deduction. And the standard deduction amounts are listed here on the screen. Single is $63.50. Again, these are 2017 amounts. Double that for married filing jointly. Head of household, a little bit more, because this is a person who is unmarried and has a qualifying child that they're providing more than half the support for. And then a qualifying widower, which again is just like a married filing joint of $12,700. We do adjust the standard deduction for people, for example, who are 65 or older or blind. So these are the adjustments then to the standard deduction for people who meet the test of being either 65 or older or blind. And so this would hit these amounts, $1,550 for single, $1,250 for married filing joint. These amounts then would add on or be combined with the standard deduction. So that I mentioned earlier, the tax liability is computed by using either the tax rate schedules or the tax tables. You might recall from Chapter 1 that we have to use the tax schedules if we have over $100,000 of income. We will talk about tax credits more in Chapter 9, but some tax credits, not many, but some are refundable. That is, they can create a refund. Others are not refundable. And so they can reduce your tax obligation down to zero, but those cannot create a refund. And we'll explore that more, as I said, in Chapter 9. And you'll also recall that we said if there's an excess payment that was made to the IRS over the taxpayer's tax liability, a refund is due. And in the event that the taxpayer is underpaid or paid less than the tax liability, then there'd be an amount owing to the IRS. So there are consequences if the taxpayer does not file a tax return, for example, and it's 5% per month or a fraction of the month not to exceed 25%. Any income tax return not filed within 60 days of the due date is subject to a minimum penalty of $210, or the amount on the tax return. So it's a serious matter to fail to file a tax return if a taxpayer is required to file a return. If in the event of fraud, which is typically understating one's tax obligation intentionally, the rate is bumped all the way up to 75%. And then there are errors. An erroneous claim for a refund or credit is a 20% on the disallowed amount of the claim if the claim for refund or credit of income filed is found to be excessive. And we'll talk in a minute about a little bit more about fraud and accuracy-related penalties. So, for example, if a taxpayer filed an automatic extension before April 15th, but sent no money to the IRS, he then filed his return by June 2nd and paid the amount due of $3,000. The amounts then that would have to be paid for failure to file a tax return would be that $3,000 times 5%, and then times 2, or $30, would be the penalty. Only 5% per month times the 2 months. As we said, or a fraction of the month counts as a full month. We will expand on more on some of these tax penalties as we move forward in other chapters throughout this course. But it's not an area of emphasis, and so we won't be talking too much about them. If you have any questions on Chapter 2, please let me know.